Hello viewers, welcome to Centricity Speaks. My name is Aditya and you're watching the first episode of Product Reckoner 101. In this series, we'll be discussing some very specific product strategies and sub-asset classes for the benefit of our viewers. In recent times, fixed income has seen a lot of innovation in terms of introduction of newer product classes and sub-asset classes, especially in the light of taxation changes which have been brought about or introduced in the latest budget, which has essentially brought debt mutual funds at the same pedestal as fixed deposits in terms of the taxation that both of them enjoy. Under these circumstances, we expect that this innovation in terms of introduction of newer sub-asset classes is only going to increase. In this episode, we will cover one such new and fresh sub-asset class which has been introduced in the Indian capital markets, which is non-dilutive growth capital, which is better known as revenue-backed capital. I have with me my colleague Vinayak Magotra to discuss with me this new product class. So Vinayak, what is your view on revenue-backed capital financing or non-dilutive growth capital as it is called, and how will it help in increasing yields in a fixed income portfolio or rather act as a supplementary product in investor portfolios?
So Aditya, basically after the change in the debt mutual fund taxation, we see now there is no arbitrage left in terms of debt mutual funds or other strategies. So now if an investor is chasing a little bit higher returns, he has to compensate that with a little bit of higher risk. So all those clients and portfolio wherein they are holding investments in let's say single issuer instruments or let's say credit funds or structured credit or private credit AIFs. So there is a new category that has come which is called rightly as mentioned by you, which is called revenue based financing or non-dilutive equity capital strategy. So in this strategy, the fund manager is trying to create a middle path between traditional source of financing wherein the companies borrow from banks, NBFCs and mutual funds and AIF. In this and somewhere between venture debt or venture equity. So what happens is usually companies borrow either from either they raise money through debt or through equity. The main merit of this strategy is the promoter of the company or the person running the company is very sure of his idea and the strength of the company, and he is not very eager or keen on selling his equity stake into the company. He just needs some part of short-term liquidity requirement, or I would say working capital, which is a 12 to 18 or 24 month tenure, and for that he doesn't want to dilute the equity. So one merit for this strategy which has a lot of conviction for me as per I say is the promoter holds the 100% or I would say majority of the stake in the company.
Sure. Thanks, Vinayak. So the specific alternate investment fund that we're discussing today, which follows this strategy, is RevX, which had earlier launched a fund under the brand name N+1, right? Managed by Mr. Rahul Chaudhary. So just wanted to ask, does RevX follow a similar strategy in terms of non-dilutive growth capital, and how successful has RevX as an N+1 been with its previous fund, which it launched in May 2021?
Okay, so RevX Capital Fund 1 as the precise name to be. So the previous fund was N+1 Capital. The fund was so they are the first one to get the license from SEBI in terms of revenue-based strategy. So they got the license in early 2021. They launched a fund in to be precise in May 2021, and now they have a 2-year track record, which is closer to 17% post expense and fees. So they have delivered a net IRR right now with 17% IRR, and the NPAs, so there is no write-offs or there is zero NPAs as of now, I can say.
So it has an impressive track record in short. So Vinayak, in summary, N+1 has had a decent track record in the last 2 years and it has delivered as per mandate. So can you throw some light on the fund manager, Rahul Chaudhary, and the management team as such, and what has their personal track record been in the past and their previous careers, etc. If you could throw some light on that for the benefit of our viewers.
So it's a 15-member strong team which is headed by Rahul Chaudhary. He has more than 25 years of experience. He has been an entrepreneur himself, and he has done his masters from Kellogg University, US. Basically, the entire team in total has more than 100 plus years of experience. They have 2000. They have disbursed 2,000 crores of funds, and overall their performance has been stellar. As mentioned, they have delivered more, gross returns of 20%, and they have a good risk management strategy as well in place.
So as far as this is a good point that you just raised, risk management. Whenever it comes to fixed income, protection of capital is a very important concern for most investors, whether it be a simple mutual fund or something as complicated as an AIF. So what is the risk preservation, as in the capital preservation or risk management strategy specifically for RevX or in the previous fund, which was N+1?
Yeah, so basically what they believe is that they have to create a diversified portfolio. So in the fund, what they are trying to do is they are trying to take positions in let's say a ticket size of 2 to 15 crores, and they are not trying to create a single position which is greater than 3% of the entire fund size or the AUM. Plus, they are also looking for companies which have a net revenue of, let's say, close to 15 to 750 crores. So they are investing in companies which have no concerns in terms of top line growth or in terms of their revenue coming up.
So these are not really startups to say which RevX will pick. So these are companies with a decent track record in terms of performance, in terms of PAT, EBITDA, etc. So these are not new companies, but these have a certain threshold of profitability or revenue growth, etc., which RevX lends to.
Exactly. So that is the point. So these companies are strong in terms of revenue. These could be PAT negative or PAT positive, but yes, there is a lot of certainty in terms of doing in terms of month-on-month revenue that these companies are generating. And one of the criteria as well for evaluating these companies are that they should have a decent track record. They should be needing this fund only for a specific time frame, which is, let's say, so the fund will be investing in companies for 12 months to, let's say, 30 months time frame. Although the fund tenure is 4 years, but they will be lending the money only for, on an weighted average, for 2 to 2.5 years.
Okay. Coming to the key terms or what we call as specifications of the fund, can you throw some light on what the tenure of the fund is? Is it extendable by a couple of years? And what is the management fee? What are the charges like? Can you discuss that for the benefit of viewers?
Yeah. So the fund tenure is 4 years, extendable by 2 years. Fund management fees, which is fixed, is roughly between 1.5 to 1.75 depending upon the share class. The fund has a hurdle rate at 12% and a performance fee at 10%.
So Vinayak, in summary, this was a very interesting discussion. So it was very refreshing to know that there are many sub-asset classes as far as high-yield fixed income is concerned. So there could be credit mutual funds, then there could be private credit funds on the AI space, venture debt funds, structured debt funds, real estate funds, and then there is an entirely new category called revenue-backed capital financing, which we just discussed, and RevX, which is a specific strategy in this particular space. So this was a very interesting discussion. I hope our viewers benefited from it. I would just like to say that for the benefit of our viewers, that this is not a series where we will suggest, recommend or advise on specific strategies or products or instruments. This is purely for the sake of discussion and for the sake of information, and all of our viewers are requested to go through the terms and conditions and the features of any of the products that we discuss in this series very closely, and lastly take the advice of their personal financial advisor or distributor or whoever one is dealing with before making any investment decision. Thank you so much, viewers. Thank you for viewing, and hope to get back to you with another episode of this series of Product Reckoner 101. Thank you.